Good morning. Oh my gosh. So what an incredible week last week.
It's been great.
Wow. So not only do we have activity picking up, we had the next big thing. We had so many things, and it's just the beginning of February.
Mm-hmm.
So I'm really excited about where this market is headed. And with that kind of in mind is where I got the quote today. So everybody knows the quote, patience is a virtue, but here's the tale. Patience is a virtue, but impatience gets things done. So I love the idea that right now we're seeing demand pick up. We're seeing the market. Of course, we're going to continue to see inventory, which I know you're going to be talking about, is this increased demand, unlimited inventory. And so all of that, but communicating with our buyers, being proactive, being a little impatient, while also being calming, is what's going to give our clients the edge of education in this market.
Yes. Well,
Right?
Education is really key right now because there are a lot of consumers out there that are misinformed about what's happening in the marketplace. And a lot of that deals with the way that we report some of the data that we lag behind by a month. And that's why these weekly updates are so important, because our market can shift very quickly, as it has just in the last 2 weeks.
It has. It's been an intense market. So what are you already seeing in title orders?
So in title orders, there's been a nice uptick in title orders just in the last week or so. And so we've been watching them steadily increase over the last couple of weeks.
Yes.
This last weekend, though, it really started to where the rubber might where the rubber met the road, and we ended up seeing a nice increase in the number of orders that came in this last week. I didn't personally see a big increase because I work with a lot more luxury agents. So I'm expecting my big pop of activity to come in starting in about 2 weeks. But some of the agents, some of the reps that work with some of the more median priced homes in areas of Metro Denver ended up seeing really nice increases in their title orders coming in. So I was really pleased to see that.
Yes. And we've seen a huge uptick in mortgage purchase applications. We've seen a lot of activity, and if not going under contract right away, what we're seeing is a lot of people that are wanting to take the next step. So what does that look like? How much money do I need to have saved? What is my credit score? How do I put myself in the best position? And some of those people are trying to get in right now because they know that as the interest rates drop, demand will continue to increase on continued limited supply. So as they're trying to take advantage of the current market, I still say patience is a virtue. You have to do it when you're ready.
Yes.
Although I will say that the best deals might be behind us because that limited inventory is keeping the market tight.
Well, and I think that those buyers that were in the market from September through December really had a good opportunity to have some negotiating power. And I think that negotiating power has been really wiped off the table for the most part.
I think so
especially if you're looking at those inner landlocked ring suburbs like Littleton, Lakewood, Eastern Aurora, Western Aurora, Eastern Denver. If you're looking in some of those areas that run around the inside edge of C470, those are some really tight areas right now where you're going to see a lot of competition.
So let's just jump in. What have we got for our data this morning?
Yeah, let's go ahead and hop into it. So this goes ahead and covers the week of February 1st through the 7th. And it was really interesting going through and looking at everything this last week because I had to put together not only the weekly numbers, but the monthly numbers through the end of January. And I was really frustrated as I was putting together the numbers for January because I didn't even want to talk about them because they're not reflective of what we're going through right now. And so all of the numbers that you see for the monthly reports that are put out by various industries talk about closings for the month of January. And that's more indicative of what happened in December. In December, it was gangbusters for the first 2 weeks of the month. And then the last 2 weeks of the month, it really shut off. And so it was not a great month. Just January was down.
Yes.
But however, when we look at these weekly numbers, you can see how much they've come up, and they've come up quite a drastic amount in terms of what's been happening. And so you can see from our strategy sheet here, looking at going into February, our cells are now starting to turn red, indicating the market is heating up pretty drastically.
That's really red really early.
Really red really early. And it adjusts as the market continues to heat up because it's always in comparison to one another. But looking at how quickly it started to heat up, we've looked at showing activity really starting to increase nicely. But looking overall at what's been happening with our average daily active count, our average daily active count dropped below 4,000 available homes for sale this last week.
Yeah.
And so again, we're going into what's called a compression point in the marketplace, where we end up having more people going under contract, more buyers in the market than homes to sell those folks. And so what happens is we see multiple offers start to rear their head again. And so we ended up seeing that our average daily active count went down by 4.6% this last week, but our pending transaction count went up by 11%. So our compression point is deepening, increasing the number of multiple offers. That drove our month supply of inventory down to 0.9. And again, that's extreme seller's market territory. But not only is it extreme seller's market territory, when that number drops below 1, it means that multiple offers become increasingly likely, because we truly have more buyers in the market than homes to sell those folks. And so my advice to you is, if you have a home for sale, or if you wanted to list your home this year for sale, looking at the months of February, March, and the beginning of April really are your best timeframes in which to list, where our inventory is low. Inventory really doesn't start to climb until about the middle of April, when people are prepping their home for summer sales. And so again, we have got this compression point that lasts from February through about mid-April, where we're putting more buyers under contract than we have homes to sell those folks. So you're able to get your home under contract in a week or two, likely pull out multiple offers, end up having a really solid contract. And so I would again encourage you to get those units under contract right now, or get those listings to market right now.
Yeah.
Now, if you have one of those listings that isn't quite as show ready, or if you're not willing to budge on making improvements to the property before you list it, maybe you have lime green walls, maybe you have an awkward floor plan, maybe you're on a busy street, get those to market as soon as possible, because you want to get those listings on the market before the cherry listings really start to show up in April and May.
So if I'm a buyer, so I'm looking at this as both a seller and a buyer. So you were pretty much just talking about, as a seller, you want to get in front of this and get your home to market as soon as possible, right? In this February to mid-April.
Yes.
So that's the point in time where this compression is the tightest. You're going to get the most for your money because you're going to have multiple bids.
Yes.
As a buyer, I thought I had a really good deal. Maybe I couldn't jump fast enough. Maybe I didn't find the home I wanted. So I keep looking through February through April, but then I really put the gas on after April. Like, what's your thought for buyers?
So for buyers, hopefully what's going to happen is, well, again, we've talked a little bit about May 10th.
Yes.
And how May 10th could be a key indicator for
the lower
inflation
interest
coming
rates
down.
Yep.
For lower interest rates coming in, but that's a gamble too.
Yes.
And so again, looking at what's happened with concessions over the last couple of months,
Mhm.
there were still about 65% of the homes that closed in the month of January had concessions on them, with an average concession of about $6,800. And so even though we're seeing multiple offers coming out, we're still seeing concessions being offered,
Mhm.
which is really interesting for rate buy downs.
Mhm.
And so you can still get into a property and still have a little bit of negotiating power, even though we're in a multiple offer situation.
Right.
There have been times where I've talked to agents and they say, well, I was in a multiple offer situation, but all the offers came in below asking price. And again, this is a very different multiple offer situation this year than what we saw last year, where homes were going for 8 to 10% over asking price. Now we're looking at 1 to 3% over asking price. So it's not nearly as extreme as what we've seen in years past. And so I would still encourage buyers to get out there and start looking, because you never know when that perfect home is going to come up for sale. And a lot more homes are likely to come on the market right after Super Bowl weekend, because we've been talking now for 10 years about how the timing of the market is the best weekend to list is right after Super Bowl weekend, when you have that great opportunity to get into a property. But after football's over, that's really the kickoff to our selling season.
Yes. And that's this weekend.
That's this weekend. And so I would expect that showings are going to be down a little bit this weekend.
Yes.
But I've also been talking to some agents who said, you know what, Super Bowl weekend is a great weekend to list, to have an open house, because those buyers that are out there are really serious.
Yes. Well, and the buyers the Denver Broncos aren't in the Super Bowl.
No.
So it could actually be a fantastic opportunity for buyers this coming up weekend.
Yes.
Right. Where some sellers are waiting, you might find that thing. And especially first-time home buyers, there's such an opportunity with renovation loans, right? You can put as little as 3% down as a first-time home buyer on a Fannie Mae renovation loan and get that home that's been passed by for the last couple months, and they're willing to negotiate. And with less probable buyers in the market, this might be the very weekend to be a buyer in.
That would be great. And
Yes.
so, of course, I would encourage you, if you're a buyer, get out there this weekend, get out on Saturday, get out early on Sunday, get home in time to watch the Super Bowl, but go ahead and get out this weekend. Typically over Super Bowl weekend, we end up seeing about a 10 to a 20% decrease in the number of showings. So get out there over Super Bowl weekend. We did see it.
And it's really just for the commercials. I mean, let's be honest. Show and the commercial.
Yes. Well, and it's funny because Broncos Nation is now rooting for Pittsburgh.
Got
Or
it.
Philadelphia? Philadelphia.
Yes,
Who's playing in the Sports Cup this weekend? Who is it?
I can't tell you.
Who's gonna score the points? I don't know. I don't know what's going to happen.
I don't know, but I want to know who's on halftime.
Yes.
Do you know that?
It's Rihanna.
It's Rihanna.
I do know that.
Okay.
I do know that much, of course.
What's important?
So we did see an uptick in new listings this last week. It came up by about 16.9%. So we're starting to see some inventory make its way to market, which is wonderful. And so again, we're starting to see more new listings come onto market, but we're not really going to see more listings on market until we get into about April, where we really see that big uptick in new listing activity. The odds of selling this last weekend jumped by nearly 5%.
Wow.
And so that's where I take into account all of the available listings for sale versus those that go under contract and or close in the same week. And so they really ended up jumping just this last week because again, our inventory is going down, but our buyer demand is really starting to pick up.
It is.
It's been interesting. The longer that we've remained in this extreme sellers market, which has been for roughly the last 10 years or so,
Yes.
but earlier and earlier buyers get to market. And so the odds of selling is continuing to go up. I would be thrilled if we end up hitting a 60 to a 65% odds of selling as we get into our spring months. That would be on pace with 2013 through 2019.
Okay.
Based off of hitting a 59.9% odds of selling in the first week of February, we could see that number even go higher than that. And so again, it's going to be a really good year for transactions. So I'm encouraged. I was really discouraged at the end of December, just looking at
it was
orders
so
that
slow.
came in,
Yeah.
and it was so slow. And with the holidays falling on the weekends, it was just not a great end of December. And so I felt really discouraged. I'm sure it came across that way as we were giving our weekly updates, but I'm feeling much more encouraged now that we're going to have a great a good
I think you hit it well. No, I'm kidding.
Yeah, I was nervous. I was definitely nervous. Now, based off of what went under contract last week with about 1,025 units going under contract, we ended up seeing that we would need for an active balanced market, we need to have about 26,500 active units to offset demand right now. And so that means that we only have about 14.7% of the inventory that we require to offset demand. And so again, looking at these new, this inventory, we're so incredibly shallow that we're not likely to see any sort of larger market correction that's going to go on. And we should see prices start to stabilize, if not go up, headed into February, March, and April. So again, looking at what's been happening over these last couple of months, we ended up getting up to about 56.6% of balance just because demand petered off so quickly over the holiday season. But right now we're back down to 14.7%, signaling extreme sellers market.
And I'm going to show a few numbers on the second half that go into the conversation around the fact that this idea of a massive correction just seems more impossible the further we get, especially as demand is increasing. We're seeing it increasing. We know the demographics behind it increasing and that inventory continuing to be low. And I can't tell you how many conversations I'm having on a daily basis, and I'm sure you are too, with agents talking to sellers who want to keep their home instead of sell it.
Yes.
That inventory will continue.
We're going to have
tough.
Inventory gridlock for a long period of time. And so with inventory gridlock going on, because people have refinanced into like 2 or 3% interest rate, they don't want to move into a smaller home for more money. And so again, people are not listing their homes, but they're going to be staying in their homes for a longer period of time. And so this year could be challenging for those agents who have relied off of their large database before, knowing that they would get a certain number of transactions out of their database. You may have to grow your database this year in order to get more transactions, because again, people are starting to stay in their homes longer.
That homeownership 10 years going up.
They're taking out HELOCs, they're renovating, they're not moving from their homes. They're choosing to stay and age in place.
Right.
Now, looking at showings this last week, they only went up by about 1.8%. We had a nice bump last week where showings went up about 14.5%. So people really started to get back out there. This weekend, I expect showings to be down a little bit, down by about 10 to 20%. So don't expect that. And so looking at what's been happening with showing activity, we're now up to about 3.8 shows per property per week. So if you didn't get your 3.8 shows per property per week last week, that could be indication number one that you might need to make a price reduction. Looking at the number of shows to go under contract, we're still looking a little bit higher than where we were last year. Last year, we were averaging about 12 shows to go under contract. This year, we're looking at about 15 showings to go under contract. So in a higher interest rate environment, what people are doing is they're taking their time, really making a solid solid decision,
Mhm.
looking at homes really closely, and they want those turnkey homes that are already updated, that are in great neighborhoods with great schools, staged well, great online presence with professional photography done on those properties in order to sell those homes. But it's about 15 showings to go under contract right now. Look at what happened with median days on market. It really declined.
Wow. Yes.
So median
quick.
days on market over the holiday period was up to 40 to 50 median days on market. I mean, the
Yeah.
market, that just shows you how quickly the market shut off during that week. But we've watched median days on market really start to drastically decline. We're now down to 16 median days on market. So these new listings that are making their way to market now are getting snapped up very quickly. We've had this large pool of potential buyers that are out there right now that have seen everything on the market for the last couple of months, haven't really liked it, but now as this new inventory is coming to market, they're getting snapped up very quickly.
Do you think a lot of the old inventory has been already under contract? I mean, are we going to see some of that with these numbers going down?
So I don't know that they've been under contract or
Yes.
not, and they've fallen apart. But I do think that there's been a lot of homes that made their way to market that might have been overpriced earlier in the year. And so now people are having to take concessions and reducing their prices in order to get those homes under contract as this new inventory makes its way to market. Looking at what we saw for price reductions, we ended up seeing that 36.2% of all the homes ended up reducing their price, with 62.5% making no change in their price. And so the rate of price reductions has gone down. Typically in February, I end up seeing about 25% of the homes make price reductions.
Okay.
So we're still seeing slightly higher than average price reductions overall in Metro Denver, but it is going down. We saw that the size of the price reduction also went down. So that's a good sign, where we're seeing about a 6% price reduction right now.
Okay.
Historically, for the month of February, I end up seeing about a 5.5% price reduction. So that's going down, not quite where we want it to be for the month of February, but it is still pretty good. For homes that are up to $500,000, again, if you look at your strategy sheets, really coming into March, April, and May are your prime time to list. As we start to get into the new year, we're starting to see this market heat up as well, where we're starting to see more listings make their way to market, more units going under contract. And in this market, we've dropped down to 0.6 months worth of inventory. It's still higher than what it was 1 year ago. 1 year ago, we ended up having 0.2, 0.3 months worth of inventory, where we were seeing those crazy multiple offers, but now we're down to 0.6 months worth of inventory, which still signals multiple offer territory. Our average daily active count ended up declining by about 7%, but our pending transaction count went up by about 12.9% this last week. And so again, there's that inversion that between that relationship of supply and demand that's drawing out these multiple offers, where we're putting more homes under contract than what we have to sell these folks.
Now that still seems low though, compared to a typical beginning of February or the end of January.
Yes.
So what would you have said, if you can recall, for this price point, would it have been 2013 to 19?
Yeah. So we're right on pace with where we should have been from 2013 through 2019.
Okay.
We're right on pace with where we should be for active inventory and pending transactions.
Got it.
The odds of selling ended up jumping 7.2% just this last week. And so now we're up to a 69.4% odds of selling, which is kind of where we were back in 2020 with our odds of selling. And so again, looking back at 2013 through 2019, we're getting to a point where we're on pace with where we should have been. In this market, we should have about 10,000 available homes for sale, whereas we only have about 1,000 homes for sale. So we only have about 10.4% of a market in balance. That's not as low as it has been for the last 2 years, but it's still historically very low overall, looking at going back from 2013 through 2019. We were looking at about 6 shows per property per week. So showings are really high in this particular market. So if you didn't get your 6 shows per property per week, that may be sign number 1 that we are priced appropriately. It's about 16 showings to go under contract. So if you've had a total of 16 showings and no offers, it may be time to reduce your price. Median days on market dropped by a couple of days again in this under $500,000 segment, where we're looking at about 12.5 shows to go, 12.5 median days on market. So it's just under 2 weeks to get your home under contract. So that could be signal number 3 if you need to make a price reduction, where it's about 12.5 days to stay on the market. Price reductions dropped down to 33.5% of the homes made price reductions in this market, with 65.7% making no change whatsoever. So price reductions are starting to go down in this market as well, with an average price reduction of about 6.1%, or about $27,500 off of that original price to get that property under contract. For 500 to $1 million, again, looking at our strategy sheet historically from 2013 through 2019, looking at March, April, early May are your best timeframes to sell. I don't like listing in May.
You don't like
No,
this?
I don't like listing in May because what ends up happening is we get stuck between all of the high school graduations, Cinco de
Yes.
Mayo. We end up having Memorial Day weekend. And so there's a lot of distraction that happens.
Yes.
I really favor those listings that go in February, March, and April. I really
Yeah.
think February, March, and April are your best timeframes in which to list.
So, but what if you don't want to move until after the summer? Your kids are in a ton of summer events. Do you wait then and skip May and just go over to June and July? Or
No, you still have a better odds of selling in May
you do
than you do
in the middle of
in
summer?
June and July.
Got it.
Our market really turns off after July 4th. So if you're coming to market in June or July, your market really ends up turning off at that point. We saw that this market really heated up this last week with all of our cells turning red, tracking the inflow and outflow of new business. Our average daily active count came down to 3.8%. Our predictive month supply of inventory also dropped below 1 month of inventory at 0.9, signaling that we're likely to have a lot of multiple offers going on in this particular market. Pending transactions jumped by about 7.6%. So buyers really got out there this last weekend. So it was good to see that some of that that activity is really starting to happen again. But our inventory continues to drop, and it's likely to continue to drop until about April, where we start to see that inventory go up. The odds of selling increased by about 4% over this last week because of that relationship between supply and demand. But we ended up jumping up to 57.9%. Again, ideally, I want to see that number somewhere between 60 to 65% odds of selling. I think is a really good number for the spring as we start to get into the heat of our market. In this market, we only have 15.5% of the inventory required to offset demand. We're looking at about 3.2 shows per property per week, and about 12.9 showings or 13 showings to go under contract in this market. So people are looking at fewer homes in this price segment before making offers.
Got it.
So it was interesting to see that. Median days on market is down to 18, whereas we had popped out to all the way to 60 as we went through New Year's weekend. It was 60 median days on market. Now we're down to 18 again. So we're looking at just over 2.5 weeks.
From 2 months to 2 weeks.
We went from 2 months to 2 weeks in a matter of about an 8-week time frame,
right?
A 4-week time frame. So again, people are picking up these properties really quickly if you get them listed for sale. We saw price reductions come down. We're now down to about 39% of homes made price reductions, with 59.3% making no price change whatsoever. The average price reduction way down to about 5.7%, which is right about where we want it to be for the month of February. It's a typical amount of price reduction. So that's a good sign to see that coming back into a more normal range rather than seeing the 60% of price reductions that we ended up seeing back at the end of November and December. As you get into the over $1 million market, this is 1 to 1.5 million. Looking at March is really your opportune time frame. April looks pretty good as well, but January, February, March are really your time frame. This market hits a little bit earlier. Looking at what happened this last week, we ended up seeing some of the red cells start to creep in. This market hits just a little bit later though.
Okay.
And so this market usually really starts to pick up after President's Day weekend. And so I expect to see a big jump in orders and activity after President's Day weekend.
Right.
Looking at our month supply of inventory, look at that. Over Christmas break and over the holidays, we were sitting at 6 months of inventory. So you had
a really balanced market for 1 week.
It was a balanced market for 1 week, guys. You had your opportunity. Now we're down to 1.1 months worth of inventory. So this number is likely to continue to drop until we hit about April.
Yes.
And so again, our month supply of inventory really indicates are we in a buyer's market or a seller's market? And even this market is only sitting at about 1.1 months worth of inventory. Pending transaction count, check that out. Week over week, it jumped by 46.2%.
Wow.
And last year was a banner year, but we're only off of last year by about 6.6% for this week. So we're not too far off of where we were 1 year ago in this market, which was an insane market. The odds of selling ended up increasing week over week by about 4.1%, or about 49% odds of selling. We're now sitting at about 12.7% of balance in this market. We would need to have about 2,322 available homes for sale in this market. And so again, this market is really tightened up. We're not looking for any signs of market correction in this particular market. We ended up seeing that shows per property per week ended up going up to about 3.2 shows per property per week. So we're seeing that number trickle upwards as well. It's about 16 showings to go under contract. So if you've had a total of 16 showings and no offers, it may be time to reduce your price. Median days on market is at its lowest point right now. For all of the other price points, we're now looking at 13 median days on market for the $1 to $1.5 million mark. So it may be time to get your listing out there even sooner rather than waiting a little bit longer until March to get your listing out there, because they're getting picked up really quickly. We only saw 24.1% of these homes reduce their price, with 74.1% making no price reduction, and a 7.9% price reduction, or about $104,000 off of the original price got you there. Looking at the $1.5 to $2 million price range, again, February and March are your good time frames. Looking into April, it looks pretty good too. It's really interesting how the pattern completely dissociates when I start playing with smaller amounts of data. But again, it's really looking at this February, March, April timeframe in which to list in. This market picked up, turned really red as well. And so again, looking at what's been happening with this market, it's really interesting to see that this market has picked up as well. We went from having 7.6 months worth of inventory over New Year's weekend down to 1.6 months worth of inventory. And so we saw our average daily active count decline by about 6.3%, and our pending transaction count ended up increasing by about 6.3%. So again, that number went up pretty drastically. We ended up seeing more market activity in this $1.5 to $2 million price range. The odds of selling increased by about 5.9%. We're only at 13.5% of a balanced market, and we saw about 3 shows per property per week in this particular market. Looking at where we are for shows to contract, people are looking at more homes in this $1.5 to $2 million price point. We're now looking at about 19.5 showings to go under contract. So if you've had 19 showings and no offers, it may be time to make a price reduction. Median days on market, again, those new listings are really the ones that are getting snapped up right now. There's this pool of potential buyers that are out there just waiting for the perfect listing to come to market.
So it's not even 18 days for the new listings, probably. It's really the same weekend. It's just these are the drag of the existing inventory that didn't get picked up. Got it.
Yep. So it's about 18 median days on market. About 38.9% of them made price reductions, with about 61.1% making no price reduction. The average price reduction is about $190,000 right now in that particular price range. So overall, things really are heating up very nicely as we get into the market, and I'm thrilled to see that. Oh, I was so downtrodden in December. Oh, I was so panicked.
December's long gone.
I'm so glad. Well, and that's why I didn't want to talk about any monthly numbers. I had planned on pulling up some of the monthly numbers so I could compare and contrast for you. If you're looking at January numbers, that's in large part due to what went under contract back in December. And it just doesn't make sense to look at those numbers anymore because our market is completely shifted in a matter of weeks back into this multiple offer situation.
So we have a couple questions. With the market returning to a stronger seller's market than September through December, what are your thoughts on which comps we should rely on, the last 6 months or an average of the last 12 months?
Oh my gosh, that's a really good question. I would probably look at the last 6 months, because we don't want to capture that run up of what happened at the beginning of 2022, because we're not on pace with where we were for the beginning of 2022. And our annual appreciation, when we start to look at the year over year price growth, it's going to be down, because I don't think we're going to hit an $820,000 average sales price in April like we did last year. And so I think that we're going to be down overall when we measure out and average out the entire year of 2023. I think we're going to end up being down about 2 or 4% between where we were at the beginning of 2022. The market conditions just don't warrant that type of run up. Prices are going to grow month over month, but overall year over year, it's not going to compare very well to 2022.
And interestingly enough, I really do think that we're going to see a very mild 1 to 3% growth. But historically, a lot of the growth is in the first 5 months of the year. And so if our growth is stifled, especially comparative to last year, it'll be really interesting to see what happens when rates do start to drop, when we see the demand pick up, and that continued pressure on the homes, to see how all this plays out. But I continue to say that real estate, nobody's buying a house today and selling it in 6 months.
No, we don't day trade homes.
We don't
day trade homes.
When you're talking long term, to buy right now while the market is a little calmer than it has been over the last couple of years, and we're walking towards lower interest rates with more opportunity and better affordability, I mean, this year really is a good year to get in. I know people want to woulda, shoulda, couldas, but you can't do that. You just can't, you can't go back in time.
This is a long-term investment. We're
Yes.
looking at your long-term gain over the next 5 to 10 years.
Yes.
If you can cut out paying rent, you're going to be in a much better position. You're investing that money rather than just giving it to a landlord.
Is there a north? Of course. Is there a North Megan Aller market update to evaluate conditions in Longmont?
Not.
Yeah,
Unfortunately, there is not. I don't have access to
No.
that MLS system, so I don't have I can't put together the same information.
Caroline jumped in. My buyers all want to keep their current homes as rentals. We're seeing a lot of that right now. And I think we will continue to see that. And we're going to be talking a little bit in the second half about the investing opportunities and sitting down strategy. I really do think that this is where you can shine, where you can be the strategist for your clients. When you think about the fact that real estate is more than likely their biggest asset and their biggest liability, the opportunity to be that financial advisor for them in the realm of real estate comes down to, is this the best property to keep? Just because it has a 2.625 interest rate on it doesn't mean it's the best property or the best rental. I've been having a ton of conversations, sit downs with real estate agents who are looking at that going, well, what can I get in rent? Does this cash flow and does this hit my long-term goals? Throwing out things like, what is the rate of return or what is the cap rate? When really I'm looking at what is the long-term benefit and when does it start to feed back, right? The appreciation, the principal reduction, the cash flow opportunities. So that's, a lot of buyers are wanting to keep it. The question is whether or not it's the right one to keep.
So question, what do you think is a reasonable price now compared to July? Up 3 to 4% more or less? No, because we peaked out. Compared to July, our home prices were up. We actually ended up falling in our average sales price from July through January. Just this last year, we've fallen by about 14%. And so you're looking at comps at the same time 1 year ago,
right?
And not looking at the comps from July. We're definitely not adding anything to that right now. You're looking at comps back in January and February of last year in order to figure out what's happening now.
Yes. I mean, after we saw that big drop off and now we're coming back. I mean, is July the equal?
I don't think July is the equal.
Not
No,
even.
because home prices continue to fall.
Yeah.
I don't think that that's an equal. I think you really got to look at comps from January of last year in order to figure out pricing right now.
As far as then the deduction from where we were last January.
Yes.
Okay. It's a tough one. Finding the right comps and determining the right market price, because you really do want to be as close to spot on as you can. And it's a little nebulous at this point, because of course it also depends on neighborhood. I mean, so many different neighborhoods and pockets are seeing a different reaction to the market, just like different metros across the country are seeing massive swings in appreciation or depreciation. And we're going to show that here in a minute as well. But really assessing what has sold recently or what has sold even in the last 12 months and doing an analysis on that, because you want to nail it.
Yeah.
You don't want to come in too high.
Yeah. It's really challenging right now.
Well, let's jump in. We're going to do the second half of this. All right. All right. So patience is a virtue. Impatience gets shit done. That's where we're at. It's how are you patient, impatient at the same time? How are you balanced in supporting your clients with that opportunity and education and information? So first off, a huge thank you to those who joined us. We had 360 agents in this room. It was packed. What an event.
It was so fun.
I didn't think we could top last year.
It was super fun.
We topped last year.
Yes.
Now we're top this year. My gosh, we had the best speakers in the best order in the highest energy. So absolutely just want to say thank you. If you attended the next big thing, we did email you a survey. We really do want those back. The surveys from last year were massive for us. The surveys from last year talked about little things, the coffee, the breaks, the blankets. It gave us some insight into thinking about doing a 1 day versus a 2 day. So please, 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 even if it's just, hey, you guys were great. We'd love to see those surveys back. So please take a minute, find that email that went out on Monday afternoon and send that back to us and look in your junk email if you don't see it in your inbox. So we've come together. We don't have enough to do. It's clearly the decision that we
got to up the game. We always got to up the game.
We have to keep. And we loved the in-person. I mean, that's the thing, right? Like we love this, and we do take a lot of joy and pride in the work that we put together to get to here, to give you guys the conversations and the opportunities for you to excel in your client communications and relationships. But we want to have that too. We want to have those one-on-ones. So the third Thursday of every month, we're going to do something. We're either going to do a mastermind, or once a quarter, we're going to do an agent ignite and bring in a speaker. Maybe social media, or maybe AI, or some sort of the off-market topics. 3 hours of market, or I'm sorry, not 3 hours, but a couple of hours of all market is a lot. But bringing in somebody that maybe's got some soft skills, how do you attack your database? How do you integrate AI? Those kinds of topics once a quarter. But every third Thursday, and you're like, I have to look at my calendar, but February 23rd is the fourth Thursday. And that's because I had a pre-existing engagement. So you guys, this is the scan this QR code if you want to join us in person. So we are going to do the live. It will be on Facebook and it will be on Zoom. So if you can't make it in person, you're not going to miss this conversation. But then we're going to talk in the room as far as, and we've given ourselves an hour, but maybe it's 20 minutes, maybe it's 30, maybe it's 45, maybe we take the whole hour. What is everybody in the room seeing in the market? What different neighborhoods are popping? What neighborhoods might be slowing down? What questions do the agents in the room have? And how do we dialogue around the solutions, right? So it's just going to be a free-for-all mastermind conversation based on the data that we've been sharing that week. It is limited to 50 seats. I do think we are going to sell out. So do make sure to scan the QR code, join us if you can. And then if for some reason something pops up and you can't make it, not a big deal. Just release a seat so we can make sure that we can get a full room and give everybody an opportunity. So we're going to see how that goes.
Yep. Something new to try.
I'm excited about
Pile it on. Pile it on.
And remember, we still have the 2-minute or under updates that we do every week right after this, that we put out on social for you guys that want to share that with your clients on your social, to say really quickly what's the highlight from Megan's talk, really quickly what's the highlight from the back half, so that you can, very consumer facing, so that you can share those. So we're doing all the things, we're listening to the feedback, we're having a whole lot of fun with this. So the shoemakers' kids are the last ones to get new shoes. That's a tee up for something that I'm going to talk about at the very end. So make sure this is my gift to you. We're going to put some shoes on those kids. We're going to put some shoes on those kids. All right. So what happened last Thursday? I was like celebrating. We were all celebrating. Interest rates were going down. The ADP numbers came out. 106,000 jobs created. That was relatively low. Powell came out very dovish. You can see where the arrows are. The markets dropped. The stock market went up. Our bond market went down, meaning our interest rates went down. It was certainly a reason to celebrate. And then the next morning, right? Then the job survey came out and it showed 517,000 jobs created, which was a surprise for everyone. So that number also gave us a really low unemployment number, 3.4%. I got to go all the way back to 1969, May, to see that number before. That is really low.
That's insane.
That is really low. And when I think about that, I showed the next big thing, the initial jobless claims. The same number was also in 1969. And I think about the fact that we have over a third more people in the country today.
Yes.
Yet to see these kind of numbers, you talk about a job crisis. I mean, we've got a very constricted job market right now. So, you know, and this is despite the layoffs. So Disney just came out this morning saying that they're laying off 7,000 people. So despite this and the other layoffs we've all heard about, whether it was Apple or Microsoft or any one of the other technology companies, I know Salesforce did it, Facebook did it, any one of these companies doing these massive layoffs, we're still seeing that the job market is tight. So with that news, the 10-year jumped. So it jumped quite a bit in one day, but it's still in a trend line where it's not jumping all the way back up. It's just jumping up, and it's probably going to start decreasing again with more good news. Good news, wage growth did slow down. Its average wages increased, the hourly wages increased 4.4%. And you're like, but it increased, and it just increased less. Last month, it increased 4.8%. This month, it increased 4.4%. So it's just slowly slowing down. This is like kind of in line with inflation where we're seeing it. Yes, it's still positive, but it's that positivity is slowing down, which is giving us that softer inflation that we were so desperately waiting on. And we will see the CPI numbers come out the next months, which will hopefully give us a nice little pop in interest rates in the downward trajectory is what my goal is for.
Mhm.
And that comes out on the 14th.
Okay.
So
We're anxious.
Yes.
We want to see those numbers.
Happy Valentine's Day. It's either going to be a
Yes.
reason to drink or drink.
Yeah.
Right. Especially for those of us in the real estate industry. Initial jobless claims increased 13,000. That number just came out this morning. So we did see some more layoffs, and that initial jobless claim did peak up slightly, and that was after decreasing and really staying low. So this is the highest number it's been in over 5 weeks. That's kind of a good sign. We don't need to see this massive destruction of wages or this massive destruction of the job market in order to make things good for the Fed. So in fact, Fed Chair Powell said, the reality is we're just going to continue to react to the data. And some of this was in his dovish tone, but this is the conversations he said after the job numbers came out on Friday. So if we continue to get, for example, strong labor market reports or higher inflation reports, well, then maybe we have to do more and raise rates more than's currently priced in. But hopefully that's not going to be the case. So we'll continue to watch that. For right now, the 30-year fixed is hovering. It did jump with that news of the jobs reports on Friday after starting to come down. But we're still in a very narrow range. This is good. It really just means that the market is waiting. What's happening? Where are those inflation reports coming? What is Powell going to do at this point? It gives us some sense of stability. And that's really what buyers need, right? They don't need a 4% interest rate. They don't need a 3% interest rate. They need interest rates to stay stable. So we can get used to it for a minute. So that is happening, and that is good news. Rate buy downs in January. So with those interest rates being a little bit above 6, we saw 57% of the January borrowers get rate buy downs. That's a lot.
That's a lot.
57%. 44% of them paid a full point. 25% of them paid over 2 points. So we're definitely seeing those folks use some of those seller concessions, especially the first half of January. We saw a lot of opportunity for buyers to negotiate. So they took that and they were buying rate buy downs. Interesting, only 3 used temporary buy downs.
That's really interesting.
It's
I
really
would think that a lot, I would have thought that number would have been a lot higher.
For all the conversations we've been having about them.
Yes.
I think in all of the contracts, we did do a number of permanents. I think we did 4 temporary buy downs.
That's insane.
But that's the whole thing. You just have to educate on both. What is the strategy? This market is so about strategy. It's not about the one Band-Aid, the one thing that's going to solve any crisis. It's about the strategy that you have to, knowing what all the tools and what all the opportunities are, and to put them to use. Mortgage purchase applications were up another 3%. This is good news. Got to go back to September 28th to see this demand. But this is not like absolute amazing amounts of demand. I mean, look at these numbers. We're still down here compared to where we were during COVID and even where we were in 2018 and 19. It's not the demand, it's the supply. And it will continue to be the supply as much as so many people are locked into these low interest rates, right?
Yep. It's going to take years to work that back out.
I think it is. I think it is. But our demand is up. It's just up comparatively. It's not up compared to the previous years still. So if we continue to see even more demand and that increasing as interest rates do drop, this is really going to put quite the pressure on that limited supply. I mean, I'm afraid is a strong word, but I am a little worried about where the spring is going to go and how much do buyers have to bid over in order to get the home, especially if it is priced right and staged right and in a good location. It's going to command additional buyers who are going to be willing to pay more in this limited market. So buyer demand started early. You can kind of see it by the trajectory of the line, yet it's still below where we were before, 13% below pre-pandemic. And I kind of just showed that to you also in the mortgage purchase application data. So this is just showing it year over year when we're looking at the rate locks. So slightly different data group, mortgage purchase applications versus rate locks. We're still under. So we still have opportunities for a lot more buyer demand, keeping us busy as the interest rates drop and as the season unfolds. CoreLogic just came out with their report this week, putting the stamp on their final appreciation for 2022. Now, remember, the national data is always going to be a bit lagging, so they just did their report for December, and they said 2022 saw a 6.9% appreciation. Now, they look at this as year over year, but this is after, I mean, remember, we had 121 months of consistent appreciation. CoreLogic is saying that we've dropped 3% from the peak, and right now we saw 6.9. Now, remember, appreciation is a little bit different. These numbers will be a little skewed from what we look at in median and average price growth, and they're looking forward, saying we expect a 3% national appreciation. These are really strong numbers. Pre-pandemic, we were looking at a historic 3.6% appreciation per CoreLogic, right? So not the medians and the averages, but the actual appreciation of every time that home trades hands. So to see these numbers, 6.9, it's still almost double. It is pretty much double what historical numbers were. So even with the decline in the second half of the year, they call out Denver as seeing a 3.9%. So that's kind of recorded. The Denver Metro per CoreLogic is a 3.9%. Now, remember, this is their year over year. They don't do a year to date. In the DMAR Metro reports, and I know more in line with your reports, when we were looking at just December year over year, we were looking at 1.5%. If we looked at a cumulative year to date at the entire year, we were looking at close to 11%. So you're looking at a wide range of numbers and trying to figure out what the differences are. Either way, it was positive, which I don't care if it was 1.5%, 3%, or 11%.
Yes.
Yes, and it was still strong. It was still an incredible market. So Selma with CoreLogic, while prices continue to fall from November, the rate of decline was slower than had been seen in the summer, which still adds up to only a 3% cumulative drop since the peak. So it just slowly stabilized. And now from that, we're already seeing it. We're certainly seeing it here in the Denver market, but that's nationwide. We're seeing that stabilization where that floor is, then which we're going to go up in prices, especially on those homes that bring in some additional demand. If I look at the entire country, very few markets. So here's where we're, in that 3% off the market, very few metros, and a lot of them on the West Coast were bigger drops. And you would kind of expect this. I mean, this is the Washington, California, Arizona. Denver made it to the top 5 list based on CoreLogic's numbers. Yet with all of the drop, the second half, we still have 48% of mortgaged homeowners still have more than 50% equity. We have this massive amount of equity, and this is just mortgage. So remember, we have all 40%, almost 40%, 39% of all homes don't even have a mortgage on them.
That's insane. I want to be one of those people.
I do too.
That would be nice.
Although it's the worst investment you could make.
Yeah.
Right? Because you can put that money elsewhere.
Right.
Okay, that's the analyst coming out of me. I know I can optimize those funds, putting them somewhere else, but it does feel good. It does feel good not to have a mortgage payment. So 40% don't even have a mortgage payment. Of those do, almost half of them, half of the 60% have more than 50% equity. So we have a very strong market, even with the small drop in equity. And this gray bars are the total equity, and these dark blue, are the tappable equity. And when people talk about tappable equity, they always go 80% loan to value, assuming, especially if you're getting a home equity line of credit or a cash out, you're limited to 80%. So that's what the difference is. So the negative equity still only 3% of all mortgaged homeowners. Again, this is only 60% of the homes. 3% of the mortgaged homeowners are actually underwater. And nobody's day trading homes.
Nobody's day trading homes.
Back to that. So holding on to those homes, it's not like you're going to sell the home because it's underwater, like you would sell a stock that just consistently loses value. You're going to sell that stock, but you still have to maintain a roof over your head. And a lot of times time solves valuation issues, especially in real estate. Colorado still stays at the bottom of the list. This is all the states where we rank. We are 4th from the bottom. We were 3rd from the bottom for a long time, but we're 4th from the bottom. Only 1.8% of our homes are in delinquent status. 0.1% are in foreclosure. 3 of them last month.
3 of them. There were 5.
Oh, there
were 5 in January.
Okay. Distress sales.
Distress sales. Out of the 2,500 that we sold.
Yes.
There were 5 distress sales.
Now, is that considered a foreclosure or just a short sale?
So it could be a foreclosure, a short sale, or a HUD property.
Okay. Okay. So 5. So it could even just have been a short sale, but still
Yes.
the assumption is that you're negative equity.
Yes.
Yeah. Unless you don't know what your equity is. And
Right.
then you got the lender a deal.
Right.
Right. So we're seeing this, we're still strong. So want to make sure tonight we talked about this in the beginning. We're going to put some shoes on those kids' feet. Tonight we have Building Investment Empire in the back room here at our office from 6:30 to 8. It is live only. There is no Zoom option, but we're talking about how do you get in? Because honestly, I've been talking about this. And if you want to RSVP for this, because you do need to RSVP, we do have a light dinner and some snacks. We want to make sure you can go to our calendar, or we'll put the link in the email that we blast out here in a couple of hours. But I've been talking about this for a year now. HELOC interest rates, the prime rate is 7.75.
Wow.
So if you go try and get a home equity line of credit, that interest rate is usually prime plus something. It might be prime plus 0 with great rate and a low loan to value, or if it's an investment property, it might be prime plus 1. Either way, when I'm sitting down and I'm talking to people, and I do a ton of one-on-one strategy sessions, and that's really what my role on this team is helping people forecast where can they go using their biggest asset. So if getting a HELOC seems painful because it's going to be up in the 8% range, and tapping into your current home because you don't want to do a cash out refinance because the interest rate is 3%, and maybe you don't want to sell it because it could cash flow, and having those conversations and putting that strategy together, it's not rocket science, but it is a strategy required. You can't just simply throw a dart and expect to get to the end with the right amount of money and assets in place. So this is about, what am I looking forward for? How am I looking at this to say, what do I want in my 90s, in my 80s, in my 70s, in my 60-year-old time frame, in my decades? And how do I get there using real estate? Those strategy sessions in assessing, what do I have today, cash flow? What do I have available to me in assets? What are my current real estate holdings? And then how do I take a step towards the next property purchase? So that's the strategy session. If you guys want to have a one-on-one, I would love to do that. I do that with a lot of our agents in helping them set up, because again, the shoemakers, kids can't be the last ones to have shoes. You as real estate agents need to be aware of the strategy that goes into real estate and then setting yourself up for success so that you can better advise your clients from a position of strength. Right? Is that whole, when you get on the airplane, you got to put your own oxygen mask on first. So you want to put your oxygen mask on first to make sure that you're capitalizing and learning what are the strategies. So with that, let's see if we have any questions. I think we might get out of here a few minutes early before we wrap this up. Okay, so Kate is confirming. Wait, you're saying find comps from January 2022 and
no. The comp from 2022 in January is going to be the comp for today, without any price decreases. But that would be your comp. Okay. Don't subtract 14% from January. You're going to find yourself completely underpriced if you do that. But the value from January of 2022 is going to be the value today. And that's because it went up and then it started to come down, and then it went back up again. So we're starting to look. So is the 23 mastermind 11 to 12 or 11 to 1? That's a great question. So we're still going to do the Zoom and the Facebook Live from 10 to 11. That is set in stone. I don't know that we've moved that other than the couple of weeks that we haven't had it. So that's 10 to 11. Then we're going to hang out for up to an hour after, from 11 to 12 in the back room. Where do we post the 2-minute highlight videos? We post them on Facebook. Do you share them on your? I share them on Facebook. Yeah, I share them on my Facebook page, and then they also go into the Agent Ignite page as well. Yes. What is your social? My social? Your social media handle. Oh my. Come on, Nicole. Come on, Nicole. Yeah. That was a Generation Z versus millennial. So you can find me on Instagram at a girl in her graphs, or it's on Facebook at Megan Siskaller, Siskaller, and then you are Nicole Ruth. Nicole Edith Ruth. Nicole Lydell Ruth. I was like, which middle name was it? Nicole Lydell Ruth. If you type in Nicole Ruth, you'll probably find me. And then the Ruth team when it comes to Instagram. Yes. And then we also have your group page. We do. Agent Ignite is a Facebook group. There's an old Agent Ignite Facebook page, but the Agent Ignite Facebook group is something that you want to get
signed up for. You just have to request it and we'll let you right in. And we post all the things in there as well.
Yep.
Yes.
Oh, got a long question. It seems to me that the job losses are mostly in high paying jobs versus lower paying jobs, which are growing. It just seems like a positive economic indicator that could be misleading. Strong economy. But for most people, the reality will not match that. That's just based off of what I'm seeing. Do you think that's where they are?
I think as soon as people lose a job, I think that they're getting rehired. I think that there's still almost 2 jobs per every unemployment person. So there's definitely opportunities. It's a shift, right? So a lot of the real estate and mortgage industries and technology industries ramped up heavy during the COVID periods or during the pandemic. And now they're having to shuffle and reassign. So just even talking about earlier today and seeing a $7,000 restructuring and layoffs, I don't know that that's going to actually hurt the current business. They're just going to reshuffle the personnel, and those people will get other jobs. And the hospitality was a big portion of the job increases. So those lower level paying jobs were eagerly looking for people who didn't want to work in those positions during the pandemic. Right. So they had a loss of folks that they're refilling.
So from Linda, when you say 5 foreclosures or short sales versus the 2,500 sales, is that for Metro Denver area or only with First American? That's with all of Metro Denver.
That makes sense.
That's not just with First American. And the same question for Nicole, when you're talking about loan applications, are you talking about your company or everyone? Also, someone asked me about North Stats. I would like to learn more a bit from Megan and put together North Stats. I'm in Windsor. I don't have a companion report for Northern Colorado.
No.
I don't have access to IRIS the same way that I do to RE Colorado, which is where I rely on all of these reports to come from. But within IRIS, you can put together some really great reports using InfoSparks.
Right.
And so I would encourage you to look at InfoSparks within IRIS in order to look at getting some of these trend reports put together.
And then the mortgage purchase applications, those numbers were national, but I will say that our team saw a very similar uptick over the last 3 weeks.
So just a couple of other commentary pieces.
I don't.
So awesome. Thank you so much for joining us, guys. We'll go
Yes.
ahead and end a couple minutes early today. And so again, the reason why we put all of this together is to help you better advise your buyers and sellers. And we certainly hope that if we're able to help you better advise your buyers and sellers, that you'll consider working with Nicole Ruth of One Trust Home Loans, or if you'll work with Megan Eller at First American Title. We would love to see you at our closing tables headed into this 2023. We need all the business we can get.
Absolutely.
And so please consider us for your upcoming transactions, and we will catch you back here next week. So until then, we'll see you guys later. Have a great weekend.
Bye-bye.